Hi guys, welcome to Accounting with Common Sense. This is your friend Junaid, and in today's video we'll be learning about debits and credits. So without further ado, let's begin the video. Okay guys, when it comes to debits and credits, please remember a word called dealer. Now before I go further into details, I just want to let you know that this video is going to be a little bit longer, but please stay with me as towards the end of this video you'll be very familiar with the concept of debits and credits. Now coming back to this word dealer. Dealer, let's split this word into half like this, DEA and LER. Let's see what is in DEA and what is in LER. So D is your dividends and drawings. E is expenses, A is assets, whereas in LER, L is liabilities, E is equity, and R is revenue, right? Now, what is expense? It is essentially a money that business spend with a view to increase the sales and with a view to be able to do their activities, daily activities properly and efficiently. Okay, the examples could be the likes of subscription fee, the likes of a maintenance fee, payroll cost, marketing costs, advertisement costs, stuff like that. The second one then is assets. This is something which business owns. So what could business own? Business could own. What could business own? A business could definitely own inventory, a stock which it would sell, obviously, right? That's business owns property. So this is something what business owns. Second thing could be all the balances and all the cash that business has in its banks. Third could be the accounts receivable, right? The people who owe business money, the debtors. And the prepayments. So prepayments are basically these expenses which haven't been incurred yet, but the business has already paid for them, prepaid them, and the services haven't been acquired yet. Now, why we're calling them assets? Simply because as the expenses haven't been incurred yet and we have already paid the money, we could definitely change our mind and get our money back, right? So that money stays as an asset until and unless the expense is finally incurred. Okay, now dividends. This is basically a money that the business pays to its shareholders. It's essentially a profit distribution towards the end of the year. Now, drawings. Drawings is something when business gives the money back to its owner. Okay, so whenever the owner invest money, which is this equity, and we're going to talk about it in a second. After investing, whenever the owner takes the money back, it takes the money out from the business for the personal uses or whatever, then that money is called drawings. Okay, the next one here on this side is liabilities. So liabilities is basically something which business owes. So who could business owe? Business could owe its suppliers, right? Business could also owe taxman money, deferred tax. Business could also owe some sort of loans, right? And business could owe any type of expenses which have incurred but the business hasn't paid them yet. Okay, so that's that. Equity is basically an investment from the owner. So whenever owner invests something, the one side would obviously be the cash element, which would be an asset, but the other side of that would be equity. So owners own money which owners invest in the business is called equity. Then this is revenue. Revenue is obviously a sales which business does. So all this, be it services or the goods, whatever business sells, that sales obviously become a revenue. Now, the question is, how did we come up with this word called dealer, right? So we will go and build this up step by step. But before doing that, I just want to talk about cost of selling, which is called COGS. And this COGS is basically an element which plays an extremely important part in undertaking the sales, right? So that's why I want to add COGS here as well, and I want to call this word C dealer. All right, and this thing I want to call it then CDEA. Okay, COGS is extremely important. What it is, it's a cost of selling, which means if you are buying something for 10 euros and you are selling it for 15 euros, then that 10 euros to make that 15 euro would become your COGS. So that 10 euro would essentially be your COGS. Okay, now again, how did we come up with all of this? Let's go back to the start. So remember this accounting equation in one of my videos. So assets are equal to liabilities and equity. Let's add P&L into it, expenses and revenue on this side, expense on this side, and then let's add dividends, drawings and COGS into it. And essentially at the end of the day you will be coming up with this word called C dealer. Okay, now please stop this video, watch it all over again and again, and I'm sure it will all make sense to you. I have to go very fast because the topic is quite huge. Right, so this side in CDA is a debit side and LER is a credit side. What happens with this side? When these things get increased, they are debit, and when they get decreased, they are credit. Similarly, these three, when they get increased, they are credit, and when they get decreased, they are debit. Let's now look into the examples and with a view to understand these things a little bit more. Now, first entry here is started business with cash 1,000. Okay, cash is an asset. It's a bank, right? And it got some money. It had zero. Now it is with 100,000 euros, right? So which means it got increased. Since it got increased, we're going to debit it. So let's call bank and increase it with 100,000. Now it's an investment, obviously, right? It's an equity. And what happens when the equity gets increased? There was zero equity before. Suddenly the equity was 100,000. So it got increased. Now we're going to, and it's going to be credited then, right? So we credit it here and call it equity. Second one, paid rent for 5,000 euros. Rent is an expense, okay? And what happens when the expenses go up, when they increase, they are debit. So in the rent account, let's open a rent account, and it got increased, so put 5,000 here, and so we paid it out of assets, out of our bank. And what happens when assets or banks get decreased? They credit. So let's open an account from here for bank, and we decrease it, we credit it by 5,000. Okay, next one is paid salaries for 10,000. Salaries, again, an expense. What happens when they get increased? They get debit. Okay, so salary, expense, or payroll, whatever you want to call it, payroll gets debited just because it got increased by 10,000, and it was paid out of assets, out of bank. So bank got reduced, right? Bank got decreased. When the bank would get decreased, it would be a credit. Okay, by 10,000. Third one, got marketing services for 800 on cash. Again, marketing expenses, marketing services for expenses that business got. Let's call this account as marketing. And how much did we get the services for? 800 euros. The expenses got up, increased, debit. Okay, so this is 800 going to be debit here. On cash, again, out of asset, bank. So which means bank got decreased. We're going to credit the bank with 800, right? Now the next one, got PR services on credit this time. Okay, so got PR services. PR services, again, an expense. It got up. Just because it got up, we're going to increase it. So let's call it public relation PR here. Excuse me, PR here with 700. And then since it got the services on credit, so obviously there is no bank which got reduced. Nothing got reduced here, right? But instead, what happened was the business increased the liability. Business hasn't paid yet, which means business has increased the liabilities. What happened with the liabilities? When they get increased, they are credit. So at least 700 is going to be credit here. Liabilities, what name should we give the liability? It's basically an accounts payable. Okay, it's a supplier from whom the business got this service, right? So let's call it accounts payable, AP, or supplier. Let's go with supplier. Now the next one, got legal and professional services for 950 on credit. Same thing, got legal and professional services, which is an expense, and I just want to go with the legal here. It is an expense which got increased. We're going to debit the expense, and it is going to be debited by 950 euros. Again, didn't pay it by cash. If we paid it by cash, we would have decreased our bank, right? But since that didn't happen, we did not pay. So since the payment wasn't done, then what happened? The liability got increased, so which means it has to be paid after a while. Now the liability has been created, so it has been increased. So let's put supplier here again. Again, the liability, we're going to call it as supplier here. So this supplier will be paid later on, whenever, by 950. Okay, purchase property, plant and equipment for 50,000 on credit. Property, plant and equipment is essentially a fixed assets, and we're just going to call them assets. Again, they got increased, so we're going to debit them here. So PPE account got debit, will be debiting by 50,000, and then since it's on credit, so credit again means that we have raised a liability called supplier, and what happens with the liabilities when they get increased, they credit. So let's just credit 50,000 here. Okay, now let's quickly move on to the next one. Prepaid advertisement expenses for Q2. Let's call it Q3, given that we are in June. So let's talk about July, August, and September. Okay, so for July, August, and September, there will be some campaign for advertisement that will be done, and that would cost us €9,000, but we need to pay it now. So we are going to pay it. All right. Once we are going to pay it, let's call the bank. Out of bank, we'll be paying it. So what happens when the assets get decreased, they get credit. Yeah, so let's credit them by 9,000. Now the question we are going to ask ourselves is, have we done this expense? Have we incurred the expense? No, we haven't. It's going to be will be done in future, right? So it's a prepayment account. So essentially, let's go and create an account for prepayment. So what happens with the prepayments? Prepayments are, as I mentioned to you, this is something we haven't incurred yet. We have just paid it. We can always go for refund. So that's why this prepayment would become our asset. So what happened with the assets when they get increased? We debit them, right? There was nothing as of now. Suddenly we got a prepayment of 9,000, which means it got increased. So we're going to debit this 9,000. Okay, right. Then purchase inventory or stock for 20,000 on credit. So inventory is an asset. It got increased. We're going to create an account for inventory for 20,000. It's a debit. It's an asset, and it got increased, so we're going to debit it. Okay, so 20,000 here. Now it's on credit. So again, liability. We have put ourselves, upon ourselves a liability here. Liability got increased. Supplier is what we're going to call this liability, and since it's increased, so we're going to credit it. Okay, so we're going to credit this by 20,000. Paid dividend to shareholders for 1,000 cash dividend. So this is the dividend, and when it will get increased, it will be a debit. So let's create a dividend account. And now that it's got increased by how much? By 1,000. So since it got increased, we're going to debit it. Okay, so 1,000 here. Now out of cash, again, bank. So bank is an asset. What happens when it gets decreased? It is a credit one. Then it gets credit then, right? So 1,000 here. Again, owner withdrew cash for 500. Whatever money is taken out by the owner, we call it drawings. So let's create a drawing account here. So there was nothing as of yet. Now suddenly he took 500 out, so which means drawings balance got from 0 to 500. It got increased, so we're going to debit that by 500. Okay, and then by cash. So again, bank is an asset. Asset is decreasing. We're going to credit the bank by 500. Okay. Quickly, so got loan for 60,000 for 3 years. Got loan 60,000, which means payment came into the money. Payment came into the bank. So bank is an asset. Bank would be increased. So bank is an asset. It's going to be increased. So we're going to debit the bank. Okay. So bank is here. We are going to increase it by 60,000. Right, it's a loan. Loan is a liability. Loan is something that we owe, the business would owe, right, to the banks, to the lender, to the financial institution. So we increase it. And what happened when we increase liabilities? We credit them. So let's call this liability a loan liability, and we are going to credit it because we increased it. Okay, estimated consultancy services for 1,000. Now estimated, it's an estimated. All right, guys. So which means we have incurred this expense, this consultancy expense, but we haven't got the invoice yet. If we had the invoice, we would know that one would be our expense and the second side would be our accounts payable, right? But this is just an estimated cost. So at least we know that it's a consultancy services is an expense, and what happens with the expense when they get increased? They're debit. So let's just put consultancy here, and we are going to debit it by 1,000. The question is, what are we going to credit? Do we have so obviously it says it's a liability, we haven't paid it, right? Oh, sorry, estimate. Oh yeah, sorry. So the estimated consultant services for 1,000. Yeah, we haven't paid them. We are only estimating. So what are we going to do now is we can't put accounts payable here simply because we don't have an invoice. Why? How do we know we don't have an invoice? Because we're estimating, right? We're only thinking to ourselves. So which means there has to be another account in the liability sections which we could use to record this. And that could be our accrued cost, right? We don't know the accounts payable as yet, but since we don't have an invoice, so let's just put it into accruals and call it. And what happens, sorry, what happens with the liabilities when they increase? They credit. That's why we are crediting the accruals here. Okay, now again, the second one is estimated electricity bill for 850. We have another estimate here with us that we have incurred electricity by 850 euros. We haven't got the bill or invoice yet, so that's why we will not put it into accounts payable. So this is electricity expense. It's an expense got up, what got increased, so we're going to debit it by 850 euros here, and it is again an accrual. So we don't have the invoice. If we had an invoice, guys, we would put it into accounts payable. So since we do not have an invoice, we're only estimating it. At the end of the day, it is our liability, all right. And when liability gets increased, they are credit. Okay. Now, the sold 10,000 so worth of goods for 20,000 on cash, and this is why I added the COGS element. Let me just explain that to you. Sold 10,000 worth of goods for 20,000 on cash. So we know that sale happened, right? Sale happened for how much? 20,000. So sale is revenue here. When it gets increased, it is credit. So let's credit the sales by 20,000. And on cash means in our bank. Then we got that 20,000 asset. Bank is an asset. It got increased. We're going to debit it. So debit 20,000. So bank will be debited by 20,000. Now, how much expense that we incurred? How much expense we incurred in order to make this 20,000? We bought this stuff for 10,000. Okay, so which means we had inventory for 10,000, and we had the cost of making this sales for 10,000. all right, inventory is now gone because we have incurred the sales, so which means inventory is an asset. It went down, decreased, so we're going to credit our inventory, and this was the cost which we incurred in order to make this sale. So COGS is going to be debit simply because it got increased. All right, so we're going to put 10,000 here. Okay, guys, now this is how it is. Please stop the video and keep watching it, keep repeating this video so that it makes sense to you. Now, the last one, sold 10,000 worth of, it's essentially, it's exactly the same entry, but this time we had a cash element in it, and this time we have a credit element in it. So sold again 10,000 worth of goods for 20,000 on credit. So again, we made a sale here. For how much? For 20,000. Sale when it gets increased, we credit it. So let's credit the sales. 20,000. Did we get the money in the bank? No, because it's on credit. So what did we do? We actually didn't get any money in the bank. However, we increased our another asset, which is our debtor, like our accounts receivable, right? So our accounts receivable, if we would get had we got the cash, we would just debit our bank, which was an asset, but we didn't get a cash. We gave the stuff on credit, so which means we increased our accounts receivable, which is again an asset. So what happens when you increase the asset, you debit it. Okay, so debit just by 20,000 euros. Again, how much inventory did we lose? Sorry, down here, how much inventory did we lose? We lost 10,000 worth of inventory in order to make this sale for 20,000, and so inventory is our asset, but it gets decreased. It is credit, so let's credit it by 10,000, and effectively this is the cost of our goods sold as well. So all the sales of 20,000 that we made, we incurred a cost for 10,000. So what happened with this cost? This cost, when it gets increased, it is a debit. So let's put 10,000 here. Okay, guys, so this is it. 10,000. So guys, this is it. Hopefully it will make sense to you. Please watch this video again and again and stop it. The topic was quite huge, that's why I had to speak with like a bullet train. So hopefully you would like this video. Thank you, guys.